What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown. Right now, junk bonds are flashing a large warning sign, a sign that they have only given twice in the last 2 decades, one preceding the dotcom bubble burst and the other preceding the '08 financial crisis. Risk premiums have dropped to their lowest levels, not seen since either of those 2 times. So what does that mean, you ask? You've come to the right place. You ready? Let's dive in. Consider with me a scenario. You've got 2 people that each want to borrow money. One of these people has a very good job. They've got no debt, they've got a ton of assets, and every time they've had debt in the past, they have a track record of paying it off exactly on schedule. The other person is basically the exact opposite. They have little to no income, they've got a bad track record with debt, they currently already have a lot of debt, and they have little to nothing in assets. In a normal world, if they were both asking you for $100, and let's say you were going to loan both of them $100, you weren't just going to turn away person number 2, you're going to loan them both $100. Are you going to loan the money at the exact same interest rate to them? Absolutely not. To the one person who has a really good track record, you're probably going to loan them that $100 and say, you owe me $101. Charge them a 1% interest rate, maybe a little bit more. To the other person, you're going to say, hey, look, I'll loan you the money, but you got to pay me back, $110. You owe me 10% interest on that debt. That way, as time goes on and they're making their payments, you understand that you're not going to collect that much in interest from the high quality borrower, and you're okay with that because you have a much higher likelihood of getting that money back. It's more like a savings account to you. It's more guaranteed, so you get less of a return. Lower risk, lower reward. This guy, on the other hand, you think, hey, if he pays it all back, then I win. If he stops paying it back halfway through, at least I've recuperated some of what I lost simply because he was paying me a much higher interest rate that entire time. And that way, if we have to go to court, we have to settle, I have to sue for, whatever, if there's a bankruptcy and I'm trying to collect, then at least I've got a higher likelihood of getting everything back because I was getting more in interest payments along the way. And you also know that if you tried to charge the higher quality borrower 2, 3, 4, 5, 6, 7, 8%, he wouldn't have borrowed from you because there's plenty of people out there willing to lend to him at the lower interest rates. And so he'll just go somewhere else and get a loan for 1%. Now, the guy with the bad track record doesn't have that same option. He tries to go somewhere else. Nobody wants that debt. Nobody wants to lend at a much lower interest rate because of the risk. And so he's got nowhere to go. But we don't live in a normal world. Right now, we live in the age of the magic money tree, MMT, modern monetary theory, fiscal and monetary policy at full blast, full spending, full speed ahead, no brakes. And that has led to an enormous amount of money rushing into places trying to find where it can go. This means that your low quality borrower has the opportunity to turn around, walk away from you, and go to somebody else who will loan them money at 9%. Or they now have the opportunity to turn around from them and go to somebody else who will do it for 8%. And let's say you already made the deal with them. You already loaned them money at 10%. What if somebody else comes in now because they just got a bunch of money from the government and they say, hey, I would like to make a loan at 8%. That means that you can sell the debt to that person and make money on it. You've given the borrower $100 and he's going to pay you back $110. You can sell that debt to the next person in line who has all that new money. You can say, hey, pay me $101 right now today. And that way, at the end of the term of the loan, the borrower now owes you $110 instead of me. A little bit of time goes on, there's more money shoved into the system, and so there's people willing to lend at 7%. So the next person, the person who currently has that, they bought it for $101, they're getting $110 back. They turn around and they say to somebody, hey, buy this debt from me at $102 or buy it from me at $103. Every time they sell it for a higher price, the full loan payoff is still only going to be $110. And so the total amount of interest that you're getting goes down every time it's sold for a higher price. The borrower is still going to have to pay back the full $110 at the end of that loan, but every time that loan is sold to somebody else for a higher price, that new buyer is ending up with a lower total interest rate on their dollar. $110. And remember, it's not just one player here. If this person is willing to spend $110 to get $110 back from a junk borrower, that means that everybody else is out there willing to do the same. And so all of the new junk borrowers come out of the woodworks and they say, hey, I couldn't borrow earlier at 10%, but if everybody's willing to lend to us low quality borrowers, us junk borrowers right now at 2% or 1%, heck yeah, I'm all on board. Give me some money. This process of pushing up junk bond prices, which at the same time that's equivalent to lowering the yields on junk bonds, has pushed junk bonds to a level that they haven't been except for 2 times in the last 20 years. Again, once right before the dot-com bubble burst and once right before the 2008 financial crisis. So the question is this time different? Well, actually, it kind of is. In some ways it is, in some ways it isn't. Number one, does this signal rot and economic trouble in the system? Absolutely, 100%. But it's a different time now in that we know now that we have policymakers at the Federal Reserve and at the Treasury who are willing to do any amount of printing necessary to paper over any losses in corporate balance sheets, in financial markets, to make sure that there are no losses anywhere. And they'll print as much money as necessary to make sure that that happens. Which means that in the past, when all these borrowers start to default for one reason or another, that would have bled over and it would have caused some sort of a market crash, some sort of bankruptcies, some sort of a recession. Whereas now, instead of letting that failure happen, the Federal Reserve just drives up the printing press and they buy all that bad debt, even though the borrowers are bankrupt. And so in a free market, would this have the potential to wipe out the system, to cause a big crash? Absolutely. There's some big rot here. But we've also seen a willingness by policymakers to experiment with things at a level and at a scale that we have not seen in United States history. Which means that while we may not see a blow up in junk bonds, you can't eliminate risk. You can only transfer it from one place to another. And as they transfer it from one place to the entire system, it makes everything else altogether a lot more fragile. And this is why I don't like bonds as an investment, simply because interest rates right now are at a place where it's virtually impossible for them to keep up with inflation. And you also don't have any upside potential in terms of the bond price because yields are so close to zero that bond prices can't move up that much higher. And so you're guaranteeing yourself a best case scenario of not even keeping up with inflation and a worst case scenario of not getting any of your money back. To me, that's a bad deal. Instead, I like to use gold as savings because gold historically for thousands of years has kept pace with inflation. And if you don't know how to get started with investing in gold, I've got my ultimate guide on how to buy gold, whether it's for savings, whether it's for in personal storage, whether you have it in private storage somewhere else, whether you have it in your retirement account or IRA. I've got all the bases covered. Check out my ultimate guide linked in the description below. As always, I really appreciate you guys. Thanks so much for watching. Have a good day.